cash flow statement. In this session, we are going to learn how the cash flow statement is prepared. What are the uses of cash flow statement? As in the previous session, we have understood that there are two types of financial statements, that is, the position statement and the income statement. But there is also a third very important financial statement which is known as cash flow statement. And this cash flow statement tells us the inflows and the outflows of the cash and cash equivalent. Cash flow statement is gaining substantial importance in the last decade because of its practical utility to the users of the financial information. Accounting Standard 3, issued by the Institute of Chartered Accountants of India in June 1981, which dealt with the statement showing changes in financial position, that is, the fund flow statement, has been revised, and now it deals with the preparation and presentation of cash flow statement. So this amendment or this change shows the importance of cash flow statement. The standard has made it mandatory for all the listed companies to prepare and present the cash flow statement along with the other financial statements on annual basis. Now, what is cash flow statement? Cash flow statement provides the information about the historical changes in the cash and cash equivalents of an enterprise by classifying cash flows into three types of activities: operating activities, investing activities, and financial activities. To prepare cash flow statement for all the years for each accounting period for which the other financial statements are presented. Now there are two terms used in the definition of cash flow statement, that is the cash and cash equivalent. As per Accounting Standard 3, cash comprises of cash in hand and demand deposits with the bank, and cash equivalents means the short-term, highly liquid investments that are readily convertible into known amounts of the cash and which are subject to insignificant risk of changes in value. So वो सारी marketable securities which can be easily converted into cash are known as cash equivalent. Other examples are preference shares of any company which are shortly acquired before the specific redemption date, and because it carries insignificant amount of the risk, so that can be considered as a cash equivalent. When there is a flow of fund from a non-cash item to the cash item, for example, the purchase of machinery or the sale of the machinery, purchase of any equipment, sale of any equipment, or collection of cash from debtors, payment to creditors, payment to the employees, receipt of dividend, interest payments, etc., we call it as there is a cash flow. And all these transactions are considered while preparing cash flow statement. But as per Accounting Standard 3, cash flows excludes any movement between the items that constitute cash and cash equivalents. For example, the purchase of marketable securities or the short-term investments, which constitute cash equivalents. लेकिन जब हम उनकी परचेज करते हैं तो परचेज करते हुए हमने कैश फ्लो स्टेटमेंट में उसकी कोई भी एंट्री नहीं करनी है. So any movement from cash item to cash item will not be considered as a part of cash flow statement. As we have discussed earlier, three types of activities are considered: operating activities, financing activities, and investment activities. Let us understand all these activities one by one. First of all, cash from operating activities. As per Accounting Standard 3, operating activities are the activities that constitute the primary or the main business or the principal revenue producing activities of an enterprise. सपोज कर लीजिए कोई कंपनी बुक्स मैन्युफैक्चर करती है, तो बुक्स मैन्युफैक्चर करने के लिए जो रॉ मटेरियल उसने बाय किया, जो उसने मैन्युफैक्चरिंग एक्सपेंसेस इनकर किए, और बुक को जो सेल करके रेवेन्यू जनरेट किया, ऑल द आइटम्स विल बी नोन एज ऑपरेटिंग एक्टिविटीज. And the amount of cash from operations indicate the internal solvency of the company, and this is regarded as the key indicator of the extent to which the operations of an enterprise have generated sufficient cash flows to maintain the operating capability of the enterprise. Paying dividend, making of new investments, and repaying of the loans without recourse to the external source of financing. So, if we want to know the internal solvency of the company, then cash from operating activities are considered. Cash inflow from operating activities include cash receipts from the sale of the goods or cash receipts from the royalty, fee, commission, and other revenues. Cash outflow from the operating activities include any payment to the suppliers of the good, payment to or on behalf of the employees, payment to the insurance enterprise for the premiums, claims, annuities, and other policy benefits, cash payment or refunds of income tax unless they are specifically identified with financing or investing activities. And the net position or the net outcome from the inflows and outflows will be considered as the operating cash flows. Second is cash from investing activities. Investing activities typically relate to the purchase and sale of long-term assets, long-term fixed assets such as machinery, furniture, land and building, etc. And all the transactions relating to long-term investments are also known as investing activities. As per Accounting Standard 3, investing activities are the acquisition and disposal of the long-term assets and other investments not included in the cash equivalents. For example, cash outflows includes payment to acquire fixed assets, including intangibles or capitalized research and debentures, cash payment to acquire share warrants or debt instruments of the other enterprises, other than the instrument which are considered as cash equivalent. तो इसका मतलब जो लंबे समय के लिए हमने इन्वेस्टमेंट की है, दैट इन्वेस्टमेंट विल बी द पार्ट ऑफ इन्वेस्टिंग एक्टिविटीज़. जो शॉर्ट टर्म पर्पसेस के लिए की है वो इन्वेस्टमेंट हमारी कहलाती है कैश इक्विवेलेंट. Then any sort of cash, advances, or loans made to the third party will become the part of investing activities. But one thing to be remembered is that these loans and advances made by the financial enterprises are not considered as a part of investing activities. In that case, they are the part of financing activities only. Then cash inflows from investing activities include cash receipts from the disposal of the fixed assets, including tangibles, cash receipts from the repayment of the advances or loans made to the third party, cash receipts from the disposal of the assets, warrants, and debt instruments, cash received in cash from the loans and advances, or interest received in the loans and advances, dividend received from investments in the other enterprises. Third thing is cash from financing activities. Financing activities relates to the long-term funds or the capital of an enterprise. For example, cash proceeds from the issue of equity shares, debentures, raising long-term bank loan, redemption of the bank loan, etc. As per Accounting Standard 3, financing activities are the activities that results in the changes in the size and composition of the owner's equity, including the preference share, and the borrowings of an enterprise. Separate disclosure of cash flows arising from this financing activity is required because it is useful in predicting the claim on the future cash flows by providers of the funds to the enterprise. अगर आपको ये जानना हो कि इस कंपनी में मैं पैसे लगाऊं या नहीं लगाऊं, या इस फर्म को, इस एंटरप्राइज को हम कैश प्रोवाइड करें या नहीं करें, तो उसके लिए अगर हम कैश फ्रॉम फाइनेंसिंग एक्टिविटी कैलकुलेट कर लें तो हमें ये पता चल जाएगा कि कंपनी की सॉल्वेंसी या कंपनी के कैश फ्लोज के ऊपर एग्जिस्टिंग क्लेम्स कितने हैं और क्या कंपनी हमें हमारा कैश वापस कर सकती है या नहीं. So cash inflows from financing activities include cash proceeds from issuing shares or other similar instruments, cash proceeds from issuing debentures, loans, bonds, and other short-term and long-term borrowings. Whereas cash outflows from financing activities include cash repayment of the amount borrowed, interest paid on the loans, debentures, and advances, dividend paid on equity, and preference capital. There are some extraordinary items also. The extraordinary items are not the regular phenomena. For example, in case there is loss due to theft or earthquake or flood. So extraordinary items are non-recurring item in nature and hence the cash flows associated with them should be disclosed separately as arising from operating activities or investing activities or financing activities. This is done to enable the users to understand their nature and their effect on the present and future cash flows of the company.